All right, just let me share my screen with you guys real quick. All right, so I just want to welcome you today. This has been our sort of ongoing series of moving to Italy with our Noi Siamo Italiani page. And we're happy to have you here with us today. We are very lucky to have the expertise of Eugene Sherayzen, who is a lawyer that deals with international taxes, or an international tax attorney. So he's joining us today thanks to Brian Fanciulli, who is part of our group and also part of the dual citizenship page, and was kind enough. He'd seen Eugene speak at one of the Italian cultural organizations, I believe in Minneapolis. So it was his connection here that brought us here today. So we're really excited to have Eugene with us. I'm going to keep this up on the screen here, and he's going to talk to you. We'll probably speak for about, he'll speak for about an hour or so about the topic. I will be fielding questions in the chat throughout. So if you have a question, like a clarification question, be sure to put that in the chat, and I will try to keep up with that and kind of let Eugene know about those. And then towards the end, we'll also have sort of a Q&A time, okay? So if you have a specific question about a specific situation, it might be best to save it for that point. But if something comes up that's relevant to, feel free, and I'll do my best. Feel free to do the hand raise thing as well. If everybody would just keep everything on mute, just so we don't have a lot of background noise, that'll help as well. And then let me know if you have any questions, okay? I'm going to, let's see, I gotta open the chat here real quick as well, just so I have it. I'll put that at the bottom. All right, so we are recording. I think we're all set. So, all right, so Eugene, if you would like to begin, I will mute myself and give you the floor.
Okay, well, good morning, everyone. I'm very happy to be here with you on this Saturday morning. And here I'm actually right now in Beverly Hills. And I was supposed to be in Europe doing the seminar, but life plays its tricks, and ended up going in the opposite direction to the west, and ended up in California. First of all, let me thank Brian and Carly for organizing this event. I was, as Carly mentioned, I presented, I believe in 2017, for the Italian Cultural Center in Minneapolis. And I have nothing but best memories of that presentation. Italians are definitely among the kindest and warmest people on earth. So when Brian proposed that I present for this group, I readily said yes. Second, let me give you a little bit of a structure of how this presentation is going to be organized. What I would like to do is organize it around the facts. Carly, could you scroll down to the second page? Yes. So here we have a hypothetical that I will use to demonstrate how U.S. international tax laws would work in this particular situation, but I'll try to generalize it and include all kinds of variations to it, so that to address maybe some of the audience's questions. We'll probably keep the hypothetical on screen, but do refer to this second page, which is really the first page. It contains a summary of all the international tax requirements that I will cover in more or less detail. But and then at the end we will have a Q&A session, as Carly said. But as also Carly said, I encourage people to ask questions throughout, especially if it's specifically about what I said, and you need some sort of clarification. Because later on, you may not remember the exact context in which the question, I may not remember the exact context in which you're asking your question. So we will have to, I'd like to use your time as efficiently as possible. Before we go there, let me say a few words about what is it I do. I'm an international tax attorney, and I own my own practice, Sherayzen Law Office Ltd. This firm specializes in offshore voluntary disclosures. An offshore voluntary disclosure is basically a way for a US taxpayer a non-compliant US taxpayer to bring himself into compliance with US tax laws voluntarily and in a way that would reduce or eliminate penalties. Eliminate is rare, reduce is much more often, but most importantly to avoid potential criminal prosecution by the US Department of Justice. So offshore voluntary disclosures, I also do annual US international tax compliance. So basically keeping my clients compliant for the current year. IRS audits, that's self-explanatory, and then international tax planning. Now in international tax planning, there are two types of clients. One are, the first type are foreigners, and that may be individuals or businesses who would like to do business in the United States. And the second type are US persons. It can be mostly US citizens or US businesses who either have assets overseas or would like to do business overseas. And today's presentation is going to be exactly within that range. It's within the second type. Today's topic is US international tax ramifications of moving to Italy. And let's delve right into it. Let's first of all quickly run through the fact scenario that we have, and then we'll go over it line by line. So there's a hypothetical Sofia Ferrari, and she moves to Italy in 2021. She's a dual citizen of the United States and Italy. And in 2021, she had the following assets: rental property in the United States, rental property in Italy, bank accounts in the US, bank accounts in Italy, with all the variations, securities, investment accounts. She also is an independent contractor, does her work through LLC in Italy and the United States. She is going to receive, or she received rather, already 50% of ownership of an Italian SRL. And there is a potential gift that she may receive. Apologies. And then she's going to engage in the sale of some of her rental properties. And she and her husband, who is an Italian citizen, who does not reside in the United States, are thinking of filing a joint tax return. The last one, number 10, is actually coming from a recent consultation that I had. So let's see. So you get the benefit of learning the answer about the consequences of doing this right today. All right, let's talk about. Let's go. As I promised, we'll go line by line, and we will involve all the principles of U.S. international taxation with it. So she's a dual citizen of the United States and Italy. Now, one important thing to remember, a critical point, which differentiates U.S. tax system from pretty much any other tax system in the world, is that a U.S. citizen is always a U.S. tax resident. I'll repeat it. A U.S. citizen is always a U.S. tax resident, no matter what other citizenship she may have. Italian, French, German, South African, doesn't really matter. Also does not matter where she resides. She resides in Italy, she resides in France. She can move to the moon if she can, find the financial means to do that, and to sustain herself on the moon. She will still be a tax resident of the United States. There are only two countries that follow that model of taxation. United States. I would normally, if we were in person, I would ask you to guess what the other one would be. But I see someone trying to actually say that what that country could be. Is correct, Eritrea. That's the first one, the first time anyone actually guessed that. Congratulations. Why Eritrea is following this model of taxation, I have no idea. I have a feeling that that they just mindlessly copied parts of US tax code without realizing what it actually means. The only country in the world that has the financial muscle to enforce something like this is the United States. No other country right now can enforce anything close to that. All right, so she is a tax resident of the United States. So what does that mean? Let's take the item number one. She has a rental property in the United States and a rental property in Italy. So she has foreign source income. As a tax resident of the United States, she is subject to the worldwide income reporting requirement. This means that she not only has to report her US source income, but she also has to report for her foreign source income. And it does not matter whether she resides in Italy or the United States. The reporting has to be done. The income has to be disclosed on her US tax returns. And I should probably say something even more important. Whether she resides in Italy or the United States, she still has to file US tax returns every year. As long as she, of course, has income sufficient to meet the requirement, filing requirement. Okay, let's delve a little bit deeper into item number one, the rental property in the United States. Well, the US source income derived from real estate is sourced to the income, sourced to the country rather, where the rental property is located, always under US law. So any type of rental income from a US property will be US source income. It will go on Schedule E as usual, no issues there. Income derived from a foreign rental property in Italy is going to be foreign source income, but it has to be disclosed in the United States. And here, this is a great illustration of the differences between domestic US tax law and US international tax law. A good way to understand the difference between the two is to think of a cake. Now, this thick fried dough of the cake, that's the base, that's US domestic law. And another thicker than usual layer of white fluffy cream on top, that's US international tax law. So US international tax law has to be based on something, on that dough. So it's based on US domestic law. But it is different. It's not a dough, it's a cream, whipped cream, if you will. And the rental property is a perfect illustration. The rental property is a perfect illustration of that difference. A US rental property is depreciated normally on a 27.5 years, whereas a foreign rental property, well, before the tax reform, it would have been 40 years. After the tax reform of 2007, it's 30 years, but it's still different. So yes, they're both depreciated. You're still required to depreciate both, but there is already a difference between what is required under US international tax law and what is required under the US domestic tax. Still going with number one. I've mentioned that you have to report foreign income on US tax returns. What if that income is subject to Italian taxes? Does it mean that this income is not reportable in the United States? No, you still have to report it. Does it mean that you are subject to double taxation automatically? No, but with reservations. There's such a concept in US tax law as foreign tax credit. So basically the idea is that you use foreign taxes to reduce your US tax liability so that there would be no double taxation. And in many cases, it works dollar for dollar, but it may not. The reason is because it is a formula, really, not a simple dollar for dollar application. The basis of that formula is that you take your foreign source income, you divide it by your worldwide income, and then you get the percentage of how much you can apply, obviously up to the tax rate established on the up to the tax rate imposed by you, the United States. But you may end up in a situation where you cannot use up your entire foreign tax credit. Part of the reason can be is because you have a lot of deductions, and these deductions, U.S. domestic deductions, and these deductions would be applied in part to your foreign income, reducing the percentage of foreign tax credit that you can pay. That foreign tax credit is not lost by any means, but it is you can carry it forward to the next year. But you have to make sure that you understand that it's not a dollar for dollar deduction. It's the common misconception that I find most people that think that they can use their foreign tax credit not only to reduce their foreign source income, but also to reduce the tax liability in the United States on U.S. source income. So it doesn't quite work this way. All right. So we now understand that if you move to Italy, you will be required to report your worldwide income. You will be required to pay US taxes on it, but you can reduce these taxes with the foreign tax credit. Now let's talk about item number 2. It has in the United States 2 bank accounts, an IRA account, and an investment account. Would Mrs. Ferrari's situation change with respect to these US assets if she moves to Italy? As long as she is a US citizen, no. It will be exactly the same situation. She still has to, she will get a Form 1099 INT for wherever income is going to be produced, and probably consolidated 1099 for the investment. For the IRA, obviously, unless she makes a withdrawal, that's not taxable. So her situation with respect to US assets is going to be exactly the same, as long as she doesn't try to expatriate, but that's a subject for another presentation. Okay. So with respect to US assets, her reporting stays exactly the same. Now let's talk about foreign assets. And what I'd like to do is I'd like to discuss items 3, 4, and 5 first as one item, and then we'll talk about them with more specificity with more specificity.
Real quick, there's a couple questions that pertain to 1 and 2, just real quick. For number 1, if the woman is has renovated this particular apartment, I'm sorry, can somebody mute yourself, whoever's talking right now? Must be someone new who entered. Sorry if you could just mute.
Can't hear it.
Hold on. Let me find and mute. There we go. All right. In any case, okay. So the question was in the chat, and it said, what if the woman had renovated the apartment and the costs were higher than the rental income? So her Italian income is negative. Would she need to report the loss, or can she choose not to disclose that information for the apartment?
A renovation of an apartment it will most likely be treated as a capital improvement, meaning that it will be depreciated rather than expensed.
Okay. Okay.
It will, and if it's, it kind of depends on what type of renovation we're talking about. But if we're talking about, I don't know, moving the walls, repainting the apartment, changing the floor, stuff like that, that will be a capital improvement that will be most likely depreciated in the same way that the apartment itself on a 30-year schedule.
Okay.
So she may not actually end up with a negative income for that particular year.
And then another one that would, I guess, pertain to number 2, can you touch on Roth IRA withdrawals? Like if she withdraws money from her IRA, I'm guessing, how does that impact?
She's a US citizen, it's going to be treated in exactly the same way.
Perfect, thank you.
Okay, so items number 3 and 4 and 5. So we're talking about bank accounts, checking account, savings account, securities account, investment account. And here I would like to introduce an important concept. If you look at the US tax law in general, like from a bird's eye view, you will see that you can divide these requirements into 2 different categories. One is, the first category consists of income tax reporting forms. So this is your form 1040, for example, you disclose your income. The other type of reporting are information returns. Now, information returns may or may not result in actual changes to tax liability. It's just the information that the US government wants you to report to them. Usually, pure information returns would not result in any actually tax liability. But the penalties for non-compliance are tremendously high. And I would refer almost immediately to the first handout where I summarize the requirements. All of these forms that I mentioned, the Form 8938, Form 114, Form 8621, 3520, all of these are information returns. Having said that, there are a lot of information returns which are hybrids. That is, you have an income tax reporting requirement and you have to disclose an asset. For example, Form 8621 is actually a hybrid form. You report the asset, but you also report an income. And we'll talk about it in more detail. So, but it's important to understand that the reporting may be required irrespective of whether there are any changes in tax liability. It's a critical concept that many people do not understand. They think, you know what, I'm not gonna, I don't really have a lot of income. I don't really need to worry about this. It doesn't matter. The reporting still has to be done. The reporting of assets still has to be done. And here I want to really mention that the only really major asset class which is not subject to any reporting if you own it individually, that is not through a company, a trust, or partnership, is real estate. Real estate is the only asset which you do not have to report. You have to report the income that you derive from the real estate. You have to report the rental income, or you have to report the capital gains from the sale of real estate. But there is no information return, at least for now, to actually that you have to file to actually say I have a house in Italy. There is no such information return. Everything else that has some sort of a cashable value, if you will, is likely to be reported in one form or another. And and again, loans, there are some loans that actually have cashable value, but most loans don't. So loan is more of a liability, not an asset. So in general, loans that if you were, for example, if you got a bank loan in order to purchase your property in Italy, then the loan in of itself usually would not be reportable. But everything else, including checking accounts, savings accounts, securities accounts, investment accounts, precious metal accounts. So for example, if you have if you have an investment in bullion, gold or silver or precious minerals, and you place them with the bank, even if the bank, even if it's in a general vault, but as long as the bank acts as a fiduciary for that asset, it will be a reportable account. Life insurance policies. This is a big one in Europe. Very big one. Because the governments provide all kinds of insurance, all kinds of tax benefits to investment insurance policies. These are also reportable accounts. It's really hard to think of financial assets that would not be reportable, to be honest with you. So going back to our description, a checking account. So a checking account, usually checking accounts do not produce any income. So it's only the issue of whether it has to be reported. And the savings account that produces interest income. Now, Mr. Ferrari is the only co-owner. So he's not a U.S. person. So as long as they don't file a joint U.S. tax return, he only needs to report 1/2 of income, of interest income. But more importantly, something that is not in this fact pattern, and I intentionally left it out, is that in reality, we don't have sufficient information to determine what are the reporting requirements. If a checking account is only $1 and a savings account is $100, let's say in securities investment, let's say all these accounts pulled together only $1,000, 1,000 euros when we're talking about Italy, that's not going to do much. You still have to file a Schedule B and say that you have foreign accounts. Now, that's also that's important to point out. Schedule B is usually used to report interest income, dividends. It's a very common form. What the vast majority of US taxpayers do not realize is that there is a Part 3 to Schedule B. And Part 3 of Schedule B is devoted specifically to international matters, particularly reporting of foreign accounts on FBAR, which I will talk about in a second, and reporting of foreign trusts on Form 3520. Now, this one I will not cover today because Italy is a continental European power. They do not follow common law. So they are extremely unlikely to recognize a trust as a separate entity. And to be honest with you, a foreign trust in of itself would be a topic of presentation or presentations, rather, depending on a specific context. But that Schedule B is actually a critical issue because if it is attached to the tax return, and let's say you do have to file an FBAR, and you mark it as no, that marking of no, or sometimes even if you leave it blank, but it is attached to the tax return, may be sufficient to kill your reasonable cost for non-filing of FBAR. At least it will make your life a lot more difficult, and your legal case for to find some sort of an excuse for non-compliance a lot more difficult. Because U.S. tax courts, unjustifiably in my opinion, but they presume that U.S. taxpayers can understand their tax returns. In most cases, they don't. In most cases, people have no idea what they're signing, actually. You can argue, and it doesn't really matter, if this person is a carpenter or he has a PhD in literature or he finished MIT. It doesn't really matter. I've had clients of all kinds of education, I've had clients from over 70 countries, very intelligent people, extremely smart, experts in their fields, but they do not understand US tax returns. And this is normal. US tax code is incredibly complex. There's not something abnormal, but the legal standard ignores that. It appears that the courts and the IRS live in another world. They live in a world where the taxpayer is presumed to have reviewed the entire tax return and to understand it. Not only that, but also read the particular parts of it where it says, so you know what, you have to file, you have to report your bank accounts. With such a unfavorable legal standard, U.S. taxpayers get into trouble very easily, especially if they have incompetent accountants who are reporting them. And I can tell you that over 70% of my voluntary disclosure cases, and I've done hundreds of voluntary disclosures, over 70% of them come to me after they were helped by an accountant, oftentimes a CPA, and it doesn't really matter what firm. I've had clients from Deloitte. I've had clients from you know what, my apologies, but it appears that my laptop is running, the battery is running low. Give me 1 second. I'll quickly reconnect this. Now we're good. I left the laptop in a safe since it's in a hotel, so it's, and obviously it wasn't charged for a while. Although it has a pretty good life. So as I was saying, I've had clients with who had accountants who were clients rather of such large firms as Deloitte, Ernst & Young, Grant Thornton. I'm not sure if it's still Grant Thornton. It might have changed its name. These large firms, they are fully competent at what they do. The problem is that their competence is usually in the center offices. The branch offices oftentimes don't know what they're doing. That's the biggest problem. It's not that they don't have the expertise, they have plenty of expertise. It's just their expertise is too concentrated. And oftentimes a local accountant doesn't realize that there is a need to involve the center office. Okay. So make sure that whenever you file a tax return, you look at your Schedule B, because the U.S. courts are going to presume that you have looked at it and understood it. All right, so going back to items number 3, 4, and 5. What's going on here is that we need to understand. We need to understand how big these accounts are. As I said, if these accounts are $1,000, they're not going to be sufficient to trigger an FBAR. But if they're $100,000, $1 million, that's a different story, obviously. For the FBAR threshold, what is FBAR? Let me first of all talk about what is an FBAR. FBAR has a very interesting history. It comes out of a Bank Secrecy Act. It is technically not a tax form. And that legal history pretty much determined its particularities. Its original intention was to fight money laundering and other financial crimes. But after 9/11, US Congress, purportedly to fight terrorism, turned over the function of enforcing FBAR to the IRS. Now, what does the IRS do with it? They immediately, you can see that from the hearings. If you read the hearings, you can see it from I talked about FBAR 3 times between 2002 and 2004. Now you can see how almost immediately the IRS switched the purpose of the form from fighting terrorism to international tax enforcement. And the interesting thing here is that you take And I see a question here. It's not MBAR, it's FBAR. It's on the form. If you look at the under foreign financial accounts on the handout, it's item number 1, FinCEN Form 114, known as FinCEN Form 114, FBAR, Report of Foreign Bank and Financial Accounts. So what is going on here is that you take the penalties for which should apply to financial crimes, and you transfer them to international tax compliance. So all of a sudden, you can go to jail for not filing an FBAR. Now that prospect, of course, scared a lot of people. And it's still scary even today. Whether it's correct or incorrect, that's not for me to decide, but it's important that you are aware of that legal history and why FBAR is so different. This is also the reason why FBAR is not filed with US tax returns. FBAR is filed separately. It used to have a completely different, almost arbitrary, you could say, a deadline of June 30th. Later on, they fixed it, and now all FBARs are due on the same date that you file your tax returns. That is April 15th. Well, for the past 2 years, that hasn't been the case, but but that's because of a very specific situation with the pandemic. And there is an automatic extension till October 15th. So even if you miss the April 15th deadline, you can still take advantage of the automatic. The FBAR requires you to disclose all foreign accounts in which you have an ownership interest, or over which you have signatory authority or any type of authority, as long as all of your foreign accounts, and I mean all of your foreign accounts, at their highest level exceed $10,000 in the aggregate. So for example, let's say you have 2 accounts. One of them is $5,000, the highest balance. The second one is $6,000, the highest balance. You meet the FBAR filing threshold. The interesting thing is that once you meet the filing threshold, you have to report all accounts. I see a question here that is it $10,000 anytime? It's $10,000 at any point. If it's even if it's a transfer for purchase of real estate, correct? Let's say you purchase a real estate for $300,000. Before that, your bank account balance was $3, and you send the money to your bank account. It sits there for a day, then it's withdrawn. Then the very next day, and you're back to $3. That rise, that jump in the balance is sufficient for you to file FBAR. Again, remember, this is a bank secrecy form. So they were interested in money laundering. So especially in usage of multiple accounts to basically launder money, you can divide it up among hundreds of accounts, and you keep moving money from one account to another until you legitimize it. That's why the rule is so strict and harsh. So as I was saying, once you have to file an FBAR, you have to file it for all of the accounts, even if the accounts are open but have 0 value, even if the accounts are dormant, even if you haven't touched an account for 20 years, no matter what, and it's all types of accounts, everything that you have, all of as I mentioned earlier, an account is defined very broadly here to include almost everything. The only thing, one major, for example, exception to FBAR reporting would be a bond, a paper bond that you have, which is not with anyone. This is just you purchased a bond directly from the company. but then this asset would be disclosed on Form 8938 that we will discuss later. The FBAR has an extremely complex penalty system, not just complex, extremely complex, which has been made even more complicated because of the various changes that were introduced to it over time. At their highest level, the most scary penalties are, of course, jail time. You can't go to jail for not filing a FBAR up to 5 years if it's compliant, if it's combined with the income tax non-compliance up to 10 years. Those, though, are extreme cases. Usually there has to be some sort of an egregious behavior that accompanies it. And it's also all about the money. How much of a non-compliance are we talking about? Have you not reported an account of $10,000? Or did you not report an account of $1 million? That makes a difference in the eyes of the IRS, because IRS, after all, is an internal revenue service. So they care about money. And pretty much all they care about is money. So all of this is being done, obviously, to figure out whether you are hiding somewhere income, reportable income. That's why the IRS is so interested in figuring this out, finding out all of this information. If you avoid criminal penalties, the next thing that you have to worry about are willful FBAR penalties. Now, willful FBAR penalties are up to $100,000 as adjusted for inflation. And if I recall correctly, right now, adjustment for inflation means $131,000 plus something. Let's just say $132,000. We'll round it up a little. Per account, well, let's put it this way, per violation. Right? Or 50% of the account, whichever is higher. Violation here, and the courts and the IRS have interpreted violation in the context of willful FBAR penalties to mean per account per year. So you have 100 accounts, you can multiply it by $100,000 or $130,000 to figure out your penalty. In reality, of course, there is a certain limit to it. The IRS doesn't want to impose absurd penalties. Having said that, a penalty of 150% of the highest account value was imposed by the IRS and upheld by court. So you can actually lose more than what you ever had, irrespective of whether it was taxable or not taxable income. But you can use it just by the operation of FBAR willful penalties. That, of course, for that to happen again, we have to do something during an audit to lead the IRS to go to the extremes. That is, either they want to make an example of you, or you've done something during an audit that was so egregious that the IRS would not want to consider any type of levels of mitigation, because there is mitigation of penalties, various levels of mitigation of penalties which are available to taxpayers. I'm not going to go through them unless there's a particular interest in it, but you can substantially reduce your willful FBAR penalties negotiated with the IRS. And that depends on how the case was conducted, circumstances, assets. It's highly fact dependent, let's put it this way. Even if you avoid willful FBAR penalties. Oh, one more thing that I should mention about willful penalties. It's important to understand what willfulness is. It's not simply that willfulness is the opposite of non-willfulness. It's an intentional or reckless disregard of the FBAR reporting requirement. So reckless disregard will be sufficient. Something like willful blindness. Let's say that you you could have learned about the FBAR requirement, but you close the ears, close your eyes, and I don't want to hear, I don't want to see it, and let's see, and let the accountant file it as it is. And then that would be willfulness. The IRS has the burden of proof to prove it, by the way, not the taxpayer. Now, if you successfully escaped willful FBAR penalties, you have to worry about non-willful FBAR penalties. So let's think about it. What does it mean? It means that even if you didn't know about the FBAR requirement, legitimately did not know about the FBAR requirement, you can still be penalized for not filing an FBAR. That's what makes it the FBAR extremely dangerous, because it's not the issue that you saw you did something bad. It's really a matter of whether you knew about it or didn't know about it. It doesn't really matter. It's almost a strict liability type of a rule. You get penalized no matter what. And not just penalized, but it's $10,000 adjusted for inflation, which is right now $13,500, something in that vicinity, per violation. Now, here's a very interesting thing. Violation in the context of non-willful FBAR penalties is not the same as violation in the context of willful FBAR penalties. At least that's the opinion of the 11th Circuit Court, which just came out within the past, I think it was about 4 to 6 months ago. We have now a series of court decisions which are favorable to taxpayers, which say that the non-willful FBAR penalties should be imposed based on the form, not on the account. So if you have 100 accounts, you still get only, your $10,000 adjusted for inflation, not more than that. The IRS has argued for now many years that it should be on a per account basis, sort of similar like willful penalties, which of course would make your $10,000 adjusted for inflation apply to each account. You can see where it's going. Let's say you have 10 accounts, and all of a sudden you're on the hook for $130,000 in penalties. But the courts initially agreed with that, but recently the courts have to read the statute differently, and in my opinion more correctly, and they started to adjust the impose the penalties, or allow the penalties rather, for only per form, not per account. But it's still far from being settled. So it can go either way. It can be per violation, can be per form. Again, there are various levels of mitigation available. Again, they're highly fact dependent. There is a reasonable cause exception. I'm not going to discuss it right now, but there is a reasonable cause exception which may allow you to avoid any environmental. Most important thing that I wanted you to understand is just how important the filing of FBAR is. Even if you fail to report anything else, make sure that you file this form if you have an account in Italy. That's a critical issue. All right, FBAR is not the only form that you have to file for your foreign accounts. There is another form called Form 8938, and it comes out of FATCA, Foreign Account Tax Compliance Act. Now, I'm not sure how many people here are aware about the existence of FATCA, so I'm going to give you a real quick rundown on FATCA. It's a very large and incredibly important piece of legislation. It truly changed the entire international legal landscape with respect to foreign account reporting. It influenced not just the US tax compliance, it influenced worldwide compliance with respect to foreign accounts. The US standard FATCA has been replicated and actually made tougher in Europe with the common reporting standard. And right now there are two camps where the most of the world follows the common reporting standard, CRS. And the United States did not join that, and they only follow FATCA. What it means is that for many foreigners, US has become a tax shelter. So actually, United States is one of the biggest tax shelters in the world, just not for US citizens, of course, but for foreigners. There is a bit of a hypocrisy in the US, official US stand with respect to tax enforcement. But nevertheless, we're not going to focus on that. What I do want to focus on with respect to FATCA is how it would affect eventually, Mrs. Ferrari in our example, but really many of you who have ties to Italy. There are two parts of FATCA which are more relevant to you than anything else. The first one concerns foreign financial institutions. Under FATCA, foreign financial institutions are basically turned into informants for the IRS. They're required to collect information about US account holders and turn it over to the IRS, either directly or through their national tax agencies. And this is obviously only possible. We're not going to take into account that this is potentially a violation of sovereignty of other countries, but this is only made possible by the fact that US dollar is the world's reserve currency. The influence, as long as US dollar occupies such a central position to international economic system, FATCA would be enforceable because no bank wants to be cut off from the US dollar system. It may mean a financial death to it. There are exceptions, of course. There are specific banks that are organized by governments, which for the specific purpose, they know that they're going to be sanctioned. They're not going to be outside of a FATCA system, but they're willing to outside of the US dollar system. But they're willing to take that risk just to avoid the reporting under US law. The second part of FATCA, which is relevant to you, is Form 8938. So on the one hand, you have the reporting of foreign financial institutions of your accounts to the IRS. On the other hand, you as a taxpayer must report these foreign accounts. Now, what happens here is that this is called third-party verification. With FBAR, you don't have that. You don't have that third-party verification, which is why FBAR is much harder to enforce in reality than FATCA. But with FATCA, now you have third-party verification, and it actually works both ways. Foreign banks report on you, if you're a responsible taxpayer who is reporting your accounts, are reporting on the foreign banks. So the IRS can see which foreign banks are identify non-compliant foreign banks through the US tax reporting and actually attack them if they want to. And they have sufficient financial means to do that. If they brought down the entire Swiss bank secrecy system between 2008 and 2013, as you know, the bank secrecy, no one with a US passport can believe in that. Then, of course, they can do it to other banks. So what does Form 8938 require you to report? Everything. Basically, it's a catch-all form. If something else is not reported somewhere else, with the exception of real estate, remember, real estate is accepted, then it's most likely will be reported on Form 8938. Like the bonds, for example, I mentioned, they're not reported on FBAR, they fall under the Form 8938. It's pretty much any type of foreign financial asset. And here, foreign financial asset is defined in even bigger to an even bigger extent. It has expanded even more than it is for FBAR. It includes, for example, your ownership of a foreign company. That's a reportable asset for Form 8938 purposes. So, for example, you bought stocks in a company and you just hold papers for paper certificates. That's a reportable Form 8938 asset. You acquired an interest in a foreign partnership. That's a reportable Form 8938 asset. You have a beneficiary interest in a foreign trust. That's a reportable Form 8938 asset. You have an interest in a foreign estate. That is, there's a foreign inheritance coming to you, but it hasn't been distributed yet. That's a Form 8938 interest, a reportable asset. So really, everything under the earth that you can think of, you can pretty much, financially speaking, you pretty much need to disclose it on Form 8938. Very dangerous form, very dangerous, with a very peculiar penalty system. On the one hand, it looks like it's better than FBAR. It's $10,000 per form, right? $1,000 total, but it has penalties such as disallowance of foreign tax credit with respect to foreign assets which have not been disclosed on Form 8938, raising the accuracy-related penalties, which are kept at 25%. It automatically raises them to 40%. So these types of penalties, which are very uncomfortable in reality, because they directly affect your income tax liability. All of that is part of Form 8938. The thresholds for reporting are a lot larger, though, for Form 8938. If you reside in the United States, for example, you're filing a single, then it's only $50,000 at the end of the year, or $75,000 at any point during the year. So jointly, you multiply it by 2. The outside of the United States, where you pretty much multiply it without going into specifics, you have to pretty much multiply it by 2 on top of that. So it's actually, you have to have good assets outside of the United States in order for them to be reportable. But because it's the reach of the Form 8938 is much broader, it is a very dangerous form. So when we going back to our scenario, when we're talking about the checking account and the savings account, we have to figure out how, we have to know how much did she have on those accounts in order to figure out whether she has to file an FBAR Form 8938. By the way, interesting thing to keep in mind: savings account, it is owned jointly, but it doesn't mean that you take 1/2 of the highest value when you figure out what you have to report. You take the full value of the account even though you only report 1/2 of the income, but the account value still take full value. Okay, let's talk about item number 4, because it is an interesting case here. We have a securities account in Italy, which is invested mostly in French and German companies. Even if it were invested in US companies, surprisingly enough, that would still be a foreign account, by the way. But the point that I wanted to make here is that here, the calculation is not that much different in terms of how you calculate the gain and loss on your foreign securities. What's different about U.S. international tax law is the currency. You have to take into account the currency impact when you figure out how much of a gain do you have or loss on sold security. So, for example, let's say you bought a security for 1,000 euros, and then in 2002, and then you sell it in 2010 for exactly 1,000 euros. Now, for Italian tax purposes, you have no gain and you have no loss. It's a 0. For US tax purposes, it will depend on whether what was the exchange rate on the date that you purchased the security and on the date when you sold the security. The difference between the two is going to be your capital gain and loss. That's a critical difference between owning securities through a foreign account and owning securities through a US account. Let's talk about number 5. This is very complex. So I'll try to simplify it as much as possible. But it is a feature of US international tax law that I have not encountered in any of the countries that I've ever dealt with. And I believe that I can safely assume that it doesn't, because I've dealt with all the major economies, with all the major countries and of all the major continents, well, all continents, I should say. It just doesn't exist anywhere. It's a purely US tax invention. What we're talking about are investments in European mutual funds. Now, there is a concept of a PFIC, passive foreign investment company. It's a purely tax invention. It has nothing to do with anything else. It just was, the law was passed in 1987. Its purpose was basically to discourage the investment, not the official purpose, unofficial purpose, my interpretation, was to discourage investments in foreign mutual funds, foreign passive investments in general, let's put it. What is a PFIC? There are 2 tests. If you satisfy either of them, you automatically a PFIC. You own rather a PFIC, you yourself or not. First of all, we're dealing with foreign corporations, not foreign partnership. It has to be a corporation. And the 2 tests are the income test and the asset test. If more than if 75% or more of income is passive income, it's a PFIC. If more than 50% of foreign assets of a corporation, passive assets, it's a PFIC. Well, what is a mutual fund? A mutual fund derives only passive income, dividends, interest, etc., because it invests into other investments, basically, other stocks, whatever. And in terms of its assets, well, it just holds usually bonds, gold, basically non-active assets. So all foreign mutual funds are automatically PFICs. All mutual fund-like investments are PFICs. In fact, some active companies could be classified as PFICs. There was a case that came out, that's quite a long time ago. I want to say about 10 years ago, maybe 8. It involved a foreign company, security company. What they were doing is they were moving cash between, from bank to bank, basically from financial institution to financial institution. Their biggest asset was cash. So even though it's definitely not a passive company, they derive their income by providing security services. Because their biggest asset was cash, the IRS classified them as PFICs. Now, why is that important, right? Why am I going into all of these details? PFIC is an incredibly highly unfavorable tax investment. Why? Because not only do you get taxed at the highest marginal tax rate in existence, but you also there is an interest charge on top of that. To explain how PFICs work, and I should mention PFICs it's an incredibly complex subject. There's not one type of PFICs. There are many types of PFICs. The one that I'm discussing right now is a default IRC section 1291 designation. There's a 1296 mark to market. There's the qualified income QEF, the qualified election fund. There are all kinds of variations. But for most people, for whatever reason, whether because they don't realize it or because it's not any type of other election is not available to them, they actually operate under the default rules. And what it means is that, let's say you have let's say you own a PFIC, you bought it for $10 10 years ago, and you sold it for $20 this year, and that means you have $10 of income. Well, that $10 you're going to be paying the highest tax marginal in existence once you allocate your gain throughout the holding period. Meaning that, I'll simplify it, very simple. You allocate this $10 to 10 years, then you take the highest marginal tax in existence for that particular year, take whether it's 35%, 37%, 39.6%, doesn't really matter. And then you impose a charge on top of that from the due date of the tax return. You add them all up, and that you get your PFIC tax and your PFIC interest. Very complex calculation. You cannot e-file your tax return if you have PFICs, because the IRS doesn't have right now the system that will effectively process PFICs. I just finished a voluntary disclosure earlier this week, and the investment was small. It was in Switzerland, relatively small, but the Swiss bankers, they really like trading, so they were trading like crazy these mutual funds, and the tax returns were so big that my secretary could not staple them. We only stapled them as 3 parts and put a rubber band around it, and then we put all 3 of these tax returns, each of them that thick, and put them in a box, an extra large FedEx box, and mailed it to the IRS. So that this is just gives you an example just how horrific this thing can be. It's definitely, after you take into account everything, all the work that goes into it, it's extremely, it's an expensive service to have these people calculated. Your usual accountant cannot do that. They have no idea what a PFIC is, let alone how to calculate them. It's only very specialized tax attorneys and tax accountants who know how to calculate them.
Okay, real quick, Eugene, I just want to I know some of our folks have to get going here soon and had some more specific questions. Is it okay if we do the Q&A at this point?
Let me just get to one more point. I wanted to touch on point number 6, and after that, we'll do the Q&A. How about that?
Okay, sounds good.
This is point number 6, where we have Mrs. Ferrari do contracting work through a US LLC, both for Italy and the United States. One important thing to remember is that her income is going to be subject to the taxation in the United States, even though the work is done in Italy. Even though it's done through, even though technically speaking, she resides in the United States, the work is done through a US business, but it doesn't really matter. You still have to report it. It's going to be subject to the self-employment tax, but I believe that there is a totalization agreement between the United States and Italy. Not to believe, I know that there is one. So that you may not be. It's gonna be very. It's a difficult calculation, because what you have to do is you have to allocate whatever income that you've earned to you have to divide it between your U.S. source income and your Italian source income. And it's gonna be the Italian source income. You can argue that it should not be subject to U.S. self-employment tax. So that's a quick point. One more point, just so that I finish. The point number 8: if you receive a foreign gift in excess of $100,000, it's reportable on a Form 3520. It's very important to do that, because even though it's not taxable, it's still subject to penalties. It's a Form 3520 is a pure information return when it comes to foreign inheritance and foreign gifts. Probably the rest of the information will have to leave for another presentation.
Thank you. I mean, it's a lot of information to take in, certainly. So we appreciate all of that. It's definitely helpful to try to navigate in terms of, what applies, because every person's situation is so different. So thank you so much, Eugene, for sharing your expertise. So I'm just going to cruise through here real quick. If I miss anybody, let me know. I know Ray's got his hand raised, so I'll let him go in a minute. But someone who's just labeled as iPad just wondered, like a simple scenario where a dual citizen moves from the US to Italy, sells the US house, buys the property in Italy, and has like a teacher's pension or something like that.
A teacher's pension, US or
US teacher's pension. So would they pay taxes both in Italy and in the US at the tax time for those? That seems to be one question.
So the sale of the there's one part of the question that I cannot answer.
Gotcha.
Not because even if I know the answer, I'm not gonna air it because I have license limitations. I cannot advise on Italian law. So how Italy is gonna tax it? It's a question for an Italian licensed attorney. From the U.S. perspective, obviously if she lived in that house and she sold it, primary residence, assuming that she didn't hold anything else within the past 2 years, then she should be able to take, and her gain is below the threshold, we wouldn't be paying any taxes on it. But otherwise, it will all the rest of the items are going to be subject to taxation. Generally speaking, based on just exactly the same as if she were residing in the United States. But it's actually an important point to emphasize. Whenever you deal with two tax jurisdictions, make sure that you have tax advisors in each jurisdiction. I've seen many times people get into trouble because they think that covering one jurisdiction is enough. No, you have to cover both.
That's good advice. Okay, great. So Christy had a more specific question here in the chat about a question about having $10,000 in an account at any time. She's about to set up an LLC and move to Italy this summer, and thought that would make things easier for taxes.
LLC where, in Italy or in the United States?
Christy, I'll let you go ahead and pop in if you want to come into this. And
yeah, so it would be an LLC in Texas, here in the US.
Okay, all right. And could you run through the effect scenario once again? So
I'm trying to make things easier for me. We're moving to Italy. I have a military spouse. We've always filed everything jointly, but it feels like we need to start filing things separately now. I'm keeping my consulting job, and currently they pay me quarterly, and it is over $10,000. So I thought maybe I need to change that payment around so I'm not getting 10,000 at a time. Or is this just related to not having more than $10,000 in my Italian account when I go to pay myself in Italy?
It's in your Italian account.
Okay.
That's what it's related to. It's really about your foreign accounts.
Okay. Perfect. Okay, thank you.
You're welcome.
And then Ray, if you want to go, and then Frank can go after Ray.
Hi, can you hear me?
Yes.
Yeah, hi. I have a few foreign non-interest bearing current accounts, and I've been filing the FBAR for 8 to 10 years. It's actually a simple form if anyone was curious about that. I find it very straightforward. My question is, the instructions for the 8938 clearly say that if I don't meet the filing threshold, that I don't have to submit that form, and I do not meet that threshold. My question is, since I file my own taxes using TurboTax software, when they ask the question, do you have any foreign accounts? I say no, because I think that's the software's way of saying, do you want to file an 8938? And I don't think I'm declaring to the IRS that I don't have a foreign account. It's just the software's way of saying, we don't have anything to do here. So can I have your interpretation on that? And then I have a follow-up question.
What's most important is not what the software says, but what your Schedule B will reflect. Schedule B reflects no, so that is that you don't have foreign accounts, and obviously you're not filing it correctly. You do need to make sure that the Schedule B reflects correctly as yes, since you're filing in that bar, and obviously it's going to be both 7A and 7B. It's going to be yes, and then I imagine you don't have foreign trusts. Then the question number 8 would be no. There is,
They're
if
not
I
interest
recall,
bearing. They're not interest bearing. So why does Schedule B come into play?
Schedule B does not, part 3 of Schedule B does not really care whether there is interest or there is no interest. What they care about is whether you have foreign accounts in which you have a financial interest, or over $10,000 in the aggregate. That's the only question.
8938, I don't have to file the 8938.
If you're below the filing threshold, it's when it comes to international tax law, you have to be a little bit. I have to be a little bit careful because obviously, based on what if you believe that you have not reached the filing threshold, then yes, you don't have to. Assuming that this is correct, then yes, you don't have to file the Form 8938. However, Schedule B still have to reflect. Schedule B is not linked to Form 8938. It's really more about FBAR actually.
So if there's no interest, there's no 1099, nothing, I would just go to Section 3 and put in the information as 0?
The part 3 of Schedule B does not, if you look at the Schedule B, if you imagine it, right, there's part 1, which, where you report the interest, part 2, where you report the dividends. Part 3 are just questions. You don't have to report how much income you've received or you didn't receive from foreign accounts. Part 3 only asks very specific information. Do you have foreign accounts? Do you have to file FBAR? That's it. First question is really, do you have foreign accounts? It doesn't even say whether you met the filing threshold for FBAR or not. As long as you have foreign accounts, the first question is going to be yes. If you once you check that, then it will ask you, do you have $10,000 or more? See, do you have to file FBAR? And that's the question. You're obviously filing FBAR, so that's also going to be yes. So it's this has to be, you have to correctly report on Schedule B.
Okay, and second, real quick, there are now purely internet banks, and it's a gray area because we don't know where the money is domiciled, where it's custodied. Are they considered foreign if it's a foreign internet bank?
It depends on where the bank is incorporated.
Okay.
Let's see, if the bank is incorporated in a country outside of the United States, then it would be a foreign financial institution. And as a foreign financial institution, then it would be a reportable, whatever the account it holds, it would be reportable.
Okay, thank you.
Frank, you can go ahead.
We cannot hear you.
How is that working?
Well, no, pretty good.
Good. Okay, so right, so I'm a financial planner, and so tax strategy comes up a lot in the discussion. At a very high level, it's about sort of reducing your lifetime tax liability. In the United States, the typical example is you retire, and between the age of retirement, let's say 70, you're now 72, you do Roth conversions. You sort of pay taxes, you accelerate tax payments to reduce taxes so that your lifetime tax liability is lower, right? Because it'll be higher in your 70s, with RMDs, et cetera. All else equal, I would kind of think that means, knowing that the tax rate differential in general, right? I think that the US has lower tax rates, Italy has higher tax rates, it's complicated, but I would think about sort of accelerating taxation for things out of, let's say, pre-tax IRA accounts before moving to Italy. If I were to retire there, thinking about Americans thinking about retiring in Italy.
One thing I want to just emphasize, even though was a disclaimer, I'm not an Italian tax attorney by any means, but Italy does have a special provision for returning Italians, which would reduce your Italian taxes by a tremendous amount. But aside from that, in general, though, you are correct. Italian taxes usually are higher than the U.S. taxes.
I've seen a couple of the new rules out, those sort of like incentives to move, especially back to southern Italy, where they'll give you like a 7% tax rate for 10 years or something like that. And sort of those very special rules accepted for a moment, right? I'm trying to think, are there general rules we can take away, or the sort of special tax treatments of things I think about typical income in retirement would be things like Social Security, right? So does Italy tax Social Security? The withdrawals from pre-tax IRAs, withdrawals from Roth IRAs. I'm not sure if those are really tax-free in Italy. That'd be good to know. And then finally, passive rental income. Is it treated any differently so that if you kept a house, let's say in the United States, and turned it into rental property, is that any better than, let's say, ordinary earned income in Italy? That's a lot, but just if there's some general rules that would be helpful.
Well, first of all, I do want to emphasize that a lot of tax law likes specificity. Having the particular fact pattern down is very important, because that may influence greatly what your strategies are going to be in terms of your financial planning, and well, from my perspective, more importantly, tax planning. Of course, I care about financial planning. I don't mean to say that it's not important. What I'm saying is that it was part of my job. That's as important. When we're talking about, I think first of all, the first general principles that must be taken into account is that whatever strategies that you are advising about you need to take into account worldwide assets. That's number one. That is, you don't want to create strategies which are good for US tax purposes, but would be bad for Italian tax purposes. Or strategies that take into account only US tax, US financial planning, but completely ignore foreign aspects of foreign assets of a client. That would be the first principle. Second, I would say, is that generally speaking, it's about the timing. Actually, the entire tax planning is about timing, it's about deferral. It's about recognizing income at the right moment. The concept of deferral is, unless there are extreme cases, but those are usually illegal. It's when you just plainly avoid paying any taxes. But if you time, in general, you want to time your recognition of income so that it would be recognized at lower tax rates, or even offset by losses. So, for example, let's say you have a currency loss build up in your foreign stocks, and you're thinking about, and you have a rental property in the United States, or even just a vacation property in the United States, because rental property can get a little more complicated because of the recapture. But you have a vacation home. Well, if you sell a vacation home, let's say you recognize $100,000 of income, probably it's a good idea to get rid of your stocks and recognize $100,000 of losses, so you end up with actually zero. You can repurchase the stocks later if you want, but almost immediately if you want. But the most important thing is to time it well. So I would say it's about those are two major principles that I would stick by. Anything else requires much more specificity to bigger degrees than that I can answer. You have to make sure that you take into account worldwide assets and the foreign tax jurisdiction considerations. Second, you time it well. Time the recognition of income well, or time recognition of losses is equally important. Well, I hope that helps.
No, that's helpful. That's helpful, sure, thanks.
Okay, thanks, Frank. We had another follow-up for the folks that were questioning about having the pension if they were living in Italy. And this might be a question for an Italian tax lawyer, but I figured I'd ask now. We could just see if they had 800, that'd be a great teacher's pension. If they had $80,000 to $100,000 a year in a pension and were residing in Italy, do you have any idea, like, how much would they have to pay in taxes to the US and to Italy? Like, what would their total tax burden be? Or would that be You can
Well,
tell.
we don't know if it's the only item on the tax return, first of all. Second, with respect to the Italian aspect, I would defer to an Italian attorney.
Sure.
With respect to U.S. Taxation, it's not going to be different from whether she resides in Italy or in the United States. It's a
Okay.
U.S. source item.
To be the same. Okay. So yeah, so really then they just need to find out from an Italian tax attorney how much their obligation to be there.
Yeah, see,
Okay.
I mean, you have to look at the entirety of the tax return from U.S. side in order to figure out what the tax liability may be in the U.S. side. But yeah, and it depends on her overall tax credit. I mean, tax bracket.
Yeah, cool. Well, thank you. All right. Anybody else have any questions at this time? If you want to raise your hand or whatever, and then we can make sure we do an order. Okay. Looks like a bunch of our folks are heading out. So anyway, final questions. I'll give the floor to anybody. Final questions. Frank, do you have another one or no? You're good?
Just do you know, right? Is Social Security taxed at as ordinary income, or however Italy defines it, the terminology for American retirees, accepting any of these special rules?
This item is definitely regulated by the tax treaty. I just trying to remember. I believe the Italian tax treaty is in the same category of German tax treaty. I believe it's going to be taxed at this. Don't take it as a conclusive as a conclusion. But if my memory serves me well, it's in the same category as a German tax treaty. I remember German tax treaty. That one is actually taxed in exactly the same way as a U.S. Social Security, actually even reported on the same line. But Italian, I believe it is in the same category as German tax treaty. I don't remember right now off the top of my head.
Great. Well, I guess in that sense, if we've got no more questions, then we will go ahead and wrap up today. Thank you so much to Eugene for being here with us today and giving us this information. It's been super, super interesting, super helpful. Yeah, thanks. Thanks everybody for coming.
You're welcome. It was my pleasure.
Yeah, absolutely. I will get a recording or a copy of this to you as well. I know you had requested that before, so Eugene, so I will get a copy of the video for you. And then for the rest of us, I will be processing this and getting it ready probably in about a week or so. And we can look forward to hopefully some other events in the future. So many thanks again to Eugene for coming and for sharing his wisdom with us. And it was very enlightening. And we really, really appreciate it. So thanks to you, Eugene. I hope you have a wonderful day. And thanks to everybody for coming out. I hope you guys have a great day. And we'll see you all soon. Okay. Ciao.
You're welcome.
Thank you.
Bye-bye.
Ciao. Bye-bye.